Inflation and green jobs. Be a very interesting topic. Dr. Kaboub is president of the Global Institute for Sustainable Prosperity, and he is an associate professor of economics at Denison University. Dr. Kaboub is an expert on modern monetary theory, the Green New Deal, and the job guarantee. He's a widely published author, and his recent work has been presented at many prestigious institutions. I'd like to welcome you. Come out and talk with us. And
thank you. Thank you for the invitation, and thank you all for being here. It's a pleasure to come back to the library for these conversations. So we've had quite a few of those pre-COVID, this current inflation cycle. So it's helpful to come back and finish the story and see where we are. So here we go. Inflation is on everybody's mind. And the dominant perspective, the narrative that we hear all the time is that inflation was caused by just way too much government spending during the COVID thing and after the COVID thing, and free checks for everybody, and also too much money pumped into the economy over the last 10 years by the Federal Reserve Bank after the 2008 crisis. So just too much money and caused inflation. So what we need to do is pull money out of the system, slow down government spending. The Fed is raising interest rates and slowing down, explicitly, the Fed is saying, if we have to, they said, we will cause a recession, right? So that's kind of the dominant narrative. And that's assuming that is the only way, right? And I'm gonna argue that we can actually kill inflation with more spending, not with less spending. So if you have a dentist appointment in 15 minutes or something, that's my argument. You have to leave if you want to listen to the details and why. This is what I'm doing here. So can we kill inflation with green jobs in particular? The answer is yes. The details here. So first of all, just so we're on the same page, what is inflation? Inflation is a persistent increase in the general price level over time. So how do we, how do we measure inflation in the US? The Bureau of Labor Statistics, which is part of the Department of Labor in the US, they do a monthly massive amount of work on a regular basis to look at the average family, average American family, not the richest, not the poorest. They look at what we consume. We buy milk, butter, clothing, all kinds of things. And they look at each item in that average basket of the average American family. Each item, they put a price tag on it. They actually look at price tags. Not the most expensive item, not the cheapest item, just on average. What's a gallon of milk? What's a tub of butter? So they give us the average of all of these items that the average family consumes. And then they calculate a weighted average. Of course, a bubble gum is not going to be as important in the family's budget as other important items. So they weigh those items based on their importance for our weekly, daily, monthly consumption. And then they calculate that weighted average. It's called the Consumer Price Index. Sometimes you hear about it, the CPI inflation, they say. So that's the index that they calculate every month. And then when that index is tracked and it changes from month to month, year to year, if it's going up, we call it inflation. If it's going down, we call it deflation. Of course, in that CPI, the thing that we call inflation, Consumer Price Index, there are some items that are actually increasing in price quite a bit, and some items that are staying stable, and some items that actually decline over time. The average is the Consumer Price Index. So sometimes we see components that are really inflating quite a bit for years, but the average inflation level is stable. So it gives us the illusion that, well, inflation is under control. Why? Because there are other items that are actually deflating. And I'll talk about which items are actually the sources of inflation in the US, pre-COVID, pre the Ukraine war and all of that. And then, of course, we'll talk about what else changed in the last 2 years to really push up prices overall for us. And I suspect you know those items because we always talk about them. It's just they've never been kind of tackled head on with policy for at least the last 2 decades. And now they're coming back to haunt us when we have all these global disruptions that trigger the spiral of inflation. So that's the CPI, Consumer Price Index I was talking about. There's two types of inflation that we should distinguish. One is called demand pull inflation, and I'll explain what it means. And the other one is called cost push inflation. So sometimes inflation is actually driven by demand. Consumers have quite a bit of income. Their wages have gone up. Unions are strong. They're demanded better wages and better benefits. So they have quite a bit to spend. So they go out and spend. It's a free country. They just cause quite a bit of demand, and the production of the economy can't keep up. The supply can't keep up. So that's called demand pull inflation. We can blame it on us becoming wealthier and having too much money, right? That's one type of inflation. The other type of inflation, cost push inflation, has nothing to do with us consumers, how much money we have, or how much the government is subsidizing or supporting. It's got something to do with, I don't know, a conflict in the Middle East, a war that caused oil prices to go through the roof, sanctions on Russia after the Ukraine that drove up commodity prices, everything that the Russian economy exports, metals and things like that. A COVID disruption that shut down manufacturing and supply chains and massive traffic jams in the oceans because of the disruption of shipping. It's got nothing to do with how much you have in your pocket or what you're consuming. It's got something to do with the supply side of the economy being disrupted and therefore causing prices to go up. So we have to pay attention to the source. Is it coming from too much money and consumers getting too wealthy and all that? Or is it all of these logistical disruptions? So that when we treat the problem of inflation, we treat it at the source. That's really the idea here, so that we know where we go into this. What about deflation? A lot of people say, well, why aren't we shooting for deflation? Why not lower prices, right? Well, it's a bit misleading, and I'll explain why. It's actually, deflation is the most dangerous thing that could happen to an economy. And it's counterintuitive. Why don't we want all prices to fall, right? I'll show you in a second. Deflation happens usually during Great Depressions, the most miserable times, right? It doesn't mean we want lots of inflation. We definitely want to avoid deflation. We want a little bit of inflation, something reasonable around 3%, 2%, maybe 4%. If we get to 5%, we get a bit nervous. Anything above 5% starts to accelerate and gets really painful. But it's not just the average price level. We also want the components of that consumer price index to be stable. We don't want some components to be inflating at 20, 25% and others deflating at 10, 15% to get our nice average that we want. We actually want the items that we care about: health, education, transportation, housing. These are very important. We don't want them accelerating at 10, 20% a year, which in some cases they have, right? So we need to pay attention to those details. So why not deflation? Deflation means the purchasing power of money increases, because deflation means that consumer price index is getting lower and lower month to month, year to year. So everything is on average cheaper, which means with the same dollar bill, I can actually buy more stuff. Sounds great. I have the same income, everything is cheaper, so I can consume more, right? My standard of living goes up. That's the first misleading intuition. Except that when prices of everything goes down, all kinds of negative consequences start to unfold, starting with something you're very familiar with. If you spent your entire life working hard, buying a house, paying it off, that's your wealth. For the average American family, the most valuable thing we own is our house. Well, with deflation, the value of your house goes down. Does that make you feel wealthier? It's not good, right? The second thing, if you're a consumer, an American consumer, like lots of young people starting their careers, buying houses, buying cars, starting a business, you probably have some debt. Well, the value of debt, the real value of debt when you have deflation goes up. I'll explain why. Let's say I borrowed, I don't know, $200,000 to buy a house. So now I owe the bank $200,000. This was before deflation. And now deflation hits the economy and persists. So month to month, year to year, deflation is happening, and now the actual value of my house is maybe $100,000 because deflation persisted for a while. But I still owe the bank $200,000 plus interest. So I'm paying the bank during times of deflation the equivalent of 2 houses, but I only own 1. So the real value of debt goes up during cycles of deflation, which means it creates massive problems for companies that have debt, for individuals that have debt. The value of your assets are going down and the value of your debt is going up. That's not a good environment for any economic system. So that's why we try to avoid deflation at any cost. So I explained the value of your house, corporate debt and consumer debt. Consumers during cycles of deflation postpone consumption, unnecessary consumption. Let's say we're going through a cycle of deflation. Like during the Great Depression in the US, deflation lasted 10 years. In Europe, deflation lasted 20 years. So it wasn't like a small thing. It was like people were born and raised in cycles of deflation. That's the biggest cycle of deflation we have. So imagine I have my income, I have my job. I didn't lose my job during the Great Depression. So I have my income and I'm thinking about buying this house. I'll walk by it and the price tag shows 100,000. I say, yeah, I think it's gonna go down because, you know, prices are falling. So how about in 2 months, maybe I'll come back and buy it. In 2 months, sure enough, it's 95. I say, well, if I wait just a few more weeks, it'll be 90. If I wait another month, it'll be 80. So all the big ticket item consumptions that we usually do, we tend to postpone and postpone and postpone until we believe we hit rock bottom. And when we all postpone consumption, we get deeper into the cycle of deflation and unemployment and a depression. So it's not good for the economy when we have deflation. It actually causes mass unemployment that shuts down economic activity. If I'm a manufacturer and I produce heavy duty industrial equipment, manufacturing stuff, when there is deflation, think about it this way. Normally I buy all my inputs, you know, the raw materials, the machinery, the equipment, all the industrial stuff that I need to use to produce a final product. And that cycle of production sometimes takes 3 months from start to finish, sometimes 6 months from start to finish. And during those 6 months, there's deflation. Prices are falling. So I'm buying all my inputs when prices are up here. And as I go by producing the stuff and packaging and delivering to the market, by the time I sell it, prices have dropped. That's not a good business model, to buy your inputs at high prices to sell your output at a low price. That's why during cycles of Great Depression, we have cycles of big deflation. Manufacturing shuts down completely. It doesn't make sense to produce. And that causes mass unemployment and it feeds into the cycle of a depression. That's why we don't want deflations. So we want some inflation, reasonable, and different components of that consumer price index to be reasonably inflating, but not some at 20% and some deflating at 15% to get an average. So deflation, as I said, coincides with disasters. We don't want that. So let's set deflation aside. Let's go back to inflation and see how we can manage it and how we can deal with it. So the dominant approach, what I call the mainstream approach, what central bankers around the world, what the Federal Reserve Bank is trying to do, kind of mainstream economic analysis, tells us that inflation is caused by too much government spending, giving consumers too much money. So in other words, they tend to believe that it's demand driven, right? Demand pull inflation. Large government deficits cause inflation. High levels of national debt, government borrowing and spending and borrowing and spending. Too much money chasing too few goods. It creates that demand pull inflation. So the other problem that they point to is quantitative easing, which is what the Federal Reserve Bank was doing after 2008, pumping billions and billions of dollars every month into the economy. So they argue we need to stop that and reverse it. So now the Fed is going through not quantitative easing, quantitative tightening, the opposite, pulling money from the financial system. So basically austerity solutions. Austerity is this fancy word that economists and policymakers use to basically say tighten our belts as a nation, right? Slow down the spending, until we get those prices under control. So the big assumption here is that this is all demand driven, right? So, but at some point, mainstream economists, this is a Fed official who just retired from the Fed a few weeks later made this comment that hit the news cycle everywhere. He basically said the Fed has no reliable theory of inflation. Now, he said this pre-COVID. This is during the almost 10-year period between 2008 and 2020, the COVID year, where the Fed and all major central banks were trying to avoid deflation. Because when we had the global financial crisis, the biggest risk was to fall into a cycle of deflation, actually have a Great Depression. That's why we call it the Great Recession, not the Great Depression, because we managed to avoid deflation. So central banks during that 10-year period were trying to push the inflation rate away from zero, that slippery slope into deflation, and they were targeting inflation at 2%. And we were below 2% for almost a 10-year period, right, after 2008. And a lot of people don't understand, why is the Fed trying to cause inflation? Well, it's because we're trying to avoid that slippery slope into deflation, which can lead to a Great Depression. So they used every trick in the textbook from a mainstream perspective to actually push inflation up to 2%, and they failed. And that's where his comment is coming from. He's saying, I guess we don't actually know what causes inflation, because we thought pumping money in the system will cause inflation. We thought lowering interest rates will cause inflation. We thought big government deficits will cause inflation. And this is not just the US. Japan has been in a cycle of deflation since the late 1990s, and they tried all kinds of things. They still can't get inflation. So the conclusion that a lot of economists came to, like the Fed in this case, I guess we don't know what causes inflation. And yet, not having a reliable theory of inflation, as soon as we started having inflation the last couple of years, they went back to the same tools, saying, well, I guess we'll just do what we usually do, raise interest rates and try to slow down the economy and see maybe it will work. So that's really the problem that we're dealing with. The policymakers have no reliable theory to use to fight inflation or to use to cause inflation when we need a little bit of inflation. And yet they keep using the same tools that they've admitted have failed. So this is the European Central Bank. This is not just picking on the US, the Bank of Japan, European Central Bank. This is their forecast of inflation, the dotted lines, versus the actual inflation. And this is them trying to push inflation. It's like not even funny. Like every single cycle, they predicted it's going to pick up. It's going to pick up. Let's do more. Let's do more. And it's not working, right? So what are the actual sources of it? Ken, go ahead.
They did it with interest rates.
Yeah, this is after 2008.
Between banks, between financial institutions.
Lowering the main interest rate that the central bank set.
So the prime rate.
They didn't really change the reserves very much, but they were pumping more into the economy.
And then they did something by
buying billions and billions of dollars worth of bonds from financial markets. So when they buy bonds from a private financial institution, they give it reserves.
Yeah.
Right.
So you're talking about the equivalent of prime rate, these banks. Here,
Exactly.
like we do prime rate here, right?
Yeah.
I just wanted to be sure I remembered that.
Sure. Yeah. So let's talk about what is actually causing these inflation pressure points. Pre-COVID, in the US, we had 4 major inflation pressure points. When you look at the composition of inflation, and you're familiar with these: healthcare, energy and transportation, I should say, housing, the real estate market, especially in some key markets where you have insane amount of inflation, and then higher education, right? Education is a little bit different. Maybe I should say a word or two since I'm affiliated with a university. When you look at the first 3 categories, you'll realize when you dig deeper that it has to do with 2 kinds of problems. One is a shortage of productive capacity. In other words, when we have a shortage of hospital beds, nurses, doctors, technicians in the healthcare industry, a shortage relative to the demand, prices go up. And sometimes that shortage is created artificially. If I have market power and I can actually dictate the quantity of production that I can bring to the system so that I create artificial scarcity and drive up prices, most likely I'm going to try to do it as much as I can to avoid antitrust problems and all kinds of things. I have to be very creative, right? So we have that lack of productive capacity, and coupled with the abusive market power, what I call abusive market power, when you actually can have enough of market concentration to be able to set prices and quantities and manipulate the system to your advantage. I don't have to tell you much about Big Pharma and Wall Street and all of that. Same thing with energy, same thing with housing, the real estate market, especially after 2008, actually. We have massive market concentration, especially in the rental market, in the hands of major Wall Street companies that gobbled up a massive amount of the supply after 2008 at dirt cheap prices. Higher education is different because it's on the receiving end of these inflation pressure points. Higher education went through a long period, especially public universities, of states reducing their support, financial support to public universities. So now how do you function? Well, you have to raise tuition to pay for your cost of doing business. So that's one source. It allowed public universities to raise tuition just to continue operating. But then you have the cost of healthcare for universities is massive. The cost of energy for heating and cooling buildings, the cost of construction because now you're competing with private schools. So you have to have the swimming pool, you have to have the gym, you have to have the nicer dorms. So the cost of construction, which is also on the receiving end of the cost of energy and market concentration. So you have all of these vicious cycles that feed into much higher cost of education. And we thought it's doable because students can just borrow, right? And they can pay. And we can all go into this endless cycle. So that's a little bit of pre-COVID, the problems that we had. The solutions that we could have introduced before we got into the trouble of COVID and the Ukraine conflict and all of these things that are added on now. Two things: increase productive capacity in these sectors. In other words, democratize access to these things. And you can do it. The good news about productive capacity is that it's producible. If we invest strategically in producing more capacity in healthcare, in energy, in transportation, in housing, in education, we can democratize access. We can increase the volume of our productive capacity, and that lowers the cost. The second thing is go after abusive market power. We haven't updated our antitrust laws in a century, essentially. And we've seen how creative corporations can be in avoiding antitrust laws. Because when antitrust laws were introduced, we didn't have anything called big tech or big pharma, right? Or all of the creative accounting that we've invented over the years. So we need to actually go after abusive market power and make the market actually competitive, right? Competition is good, right? So reducing that market concentration is critical. Now, who's going to do that? Antitrust laws. We have a Congress for that, right? That's how we function in a democracy. We call them lawmakers. They're supposed to introduce laws to make the economy more competitive, to invest more strategically, to incentivize investments in these areas, so we can actually go after the actual inflation pressure points. The only problem is the 535 people who are supposed to do that in Washington, D.C., we have this cycle of elections and super PACs and campaign contributions that creates an awkward situation, let's call it that, when you're trying to go after the hands that feed your election campaigns, a whole political system. So without getting too political, we do have a problem in terms of this intersection between politics and power and super PACs and all of that, and actual cost of living that we deal with, right? So that's pre-COVID. We didn't do that. Although we did have, what do you call it? There was a proposal a few years ago that was actually designed specifically to increase investment in healthcare, lower cost, decarbonize the energy system and make it more domestic and resilient, invest in public housing, public education, go after abusive market power. Can somebody remind me, what's that thing called? A green,
Affordable care.
a Green New Deal proposal that was designed not as the favorite shopping list of the progressives. It was designed by economists who knew what needed to be done to actually democratize access to all of these things, retool the entire US economy, and actually make these inflation pressure points irrelevant, right? We would have been much readier for this cycle of inflation had we eliminated, or at least started to eliminate these pressure points. Post-COVID, we have a global supply chain disruption. As I said, traffic jams at the oceans, China repeatedly shutting down its major manufacturing units, and as a result, disrupting everything. But it's not just a disruption, it's just how it affected us as consumers, how it affected manufacturers and retailers all over the world in terms of how they operate their business. So let's say I'm in the business of producing meat in the US. My cattle is here, my slaughterhouses are here, my workers are here. So you would think, well, why is China disrupting this or shipping disrupting? My market is here, the big market is the US. Except it turns out when you're doing meat packing, you have to put it in those styrofoam little thingies, right? Which come from China, right? So as soon as the first cycle of disruption starts, you panic. You say, well, if I don't have these styrofoam things, I can't package my meat and I can't ship it. So the next time I'm going to place an order for styrofoam thingies to be delivered, I'm going to order 3 times as much as I usually do. So everybody in the system is pretty much doing that. I'm going to order 3 times as much. And when you have a system that's actually experiencing traffic jams because everybody's ordering 3 times what the global economy normally handles in terms of shipping, you have shortage of shipping containers, shortage of wooden pallets that go into those shipping containers and all of that, shortage of ships, shortage of workers who can work 24/7 on the docks, truck drivers. So just that one COVID disruption that changed our behavior as consumers, because remember the toilet paper thing in the first, well, that imagine that on a global scale for everything, right? That's what we're still dealing with to this day, actually. That disruption is still unfolding. So until we put that thing behind us and we go back, maybe go back to businesses and consumers and shipping companies operating on a normal scale, we just don't have the capacity of 3 times what the global economy used to handle. It's just not there. So we either build the additional capacity, which will take time, or we just go back to handling things the way we were handling them. Except that one cycle of disruption convinced the whole world, including the US and Europe, that we've gone too far with this thing that we call just-in-time supply chains.
Yep.
You probably notice when you go to Walmart parking lot, sometimes you see trucks waiting in the parking lot. And sometimes they're waiting for hours or sometimes for a full day because Walmart doesn't have a warehouse. Like back in the old days, like you have the full shop and then you have a warehouse that's just as big. So you order all of your things and they get in the warehouse and then they get on the shelf. Well, Walmart and other retailers invented this just-in-time supply chain so that you bring the new stuff just in time to put it on the shelf. It doesn't need to sit in a warehouse. That costs a lot of money. So if the truck driver gets here 12 hours too early, not just in time, well, they're going to have to wait because there is no warehouse, right? So we're moving away from that just-in-time supply chains to just-in-case supply chain.
That's the Honda model, isn't it?
Everybody's model now.
Well, I mean,
Yeah.
they started with Honda.
I think so, yeah. But Walmart perfected it
Yes.
because literally they just bring the stuff on the shelf. When they scan it, they know how many pieces are missing and all that. So we're going through a global transformation of that model to just in case something happens, we need to have a little bit more, right? And that's why we're repatriating quite a bit of the strategic investments, microchips and things like that, back home instead of having an entire economy waiting for microchips to be produced and shipped from Taiwan or other places. So that's happening everywhere. Europe is doing the same. Everybody's trying to build that level of resilience. And that can't be done in 1 year. So it's causing a lot of disruptions. So that's another major inflation pressure point that we have to deal with. And then, of course, as you know, the Russia-Ukraine conflict not only caused disruption to the energy market because the size of the Russian economy in producing natural gas for an entire European continent almost, but also the food production that's Russia and Ukraine in particular, that comes out of the Black Sea through those shipping lanes to mostly to the global south, mostly to Africa and the rest of the world is massively disrupted, which is why we see the price inflation for food items, for oil and gas, but also major commodities that the Russian economy usually exports to China and India to feed into the manufacturing system that we consume here in the US and Europe. So it's all connected. So these are the three major sources of inflation. Now, how do we deal with them? I talked about the first one, pre-COVID, all of those things. We had a thing called the Green New Deal proposal for healthcare, for education. Well, ultimately, we're going to have to, deal with that, right? With investments, strategic investments in productive capacity. A lot of it is actually green jobs, which is why I talked about green jobs can kill inflation. We're going to have to deal with abusive market power, right? We've seen it actually during the pandemic. It became sort of shameless, right? Corporate CEOs on those shareholders conference calls are actually saying the pricing environment is favorable to us. In other words, if the actual cost of doing business is going up, say, by 3 or 4% because of all the things happening in the world, we're going to raise our prices by 7%, 3% to cover the actual cost of doing business, and a little bit more because everybody's kind of expecting prices to go up. So let's take advantage of this situation. And they have no choice, right? We dominate the market and everybody else is doing it. So let's do it, right? They're actually saying it explicitly. It's not even, which means if you raise your price by more than the actual cost of doing business, you're actually increasing your profit margins, which means massive profits for energy companies, for meat packing companies, for you name it. And we can go through a long list of who's actually doing this. The more market power you have, the fewer choices consumers have, the more, hands-off the government is. So we're not going to interfere with, your market power, the more advantage they'll take of the situation. So supply chains, again, the world is being transformed as we speak, and that's going to take time to unfold. So the more resilient our supply chains are, in other words, the more full control we have over the production system, the less disruption we have when China shuts down or when Russia is going through a conflict or something. So the better we insulate ourselves, doesn't mean we close our borders and becomes just one country, everybody for themselves. But notice what we're doing. We're bringing supply chains not just to the US, but closer to home in Latin America and Canada. Europe is doing the same. They're talking about technological sovereignty. They're setting up a fund for economic sovereignty to bring quite a bit of the production in the neighborhood, right? Not too far, right? So that has to happen. It's going to take time. It's not going to go away overnight. And then the conflict in Russia and the Ukraine, I mean, set aside the humanitarian disaster that's happening, millions of people displaced, thousands of people dead and injured and so on. We're not going to get rid of that source of inflation unless we actually sign a peace treaty somehow, find peace and end the conflict and start rebuilding, right? So that ultimately that's going to be the solution. I'm not an expert in conflicts or in politics and geopolitics, but from what I see, it doesn't look like we're close, right? In terms of, if anything, we're escalating shipments of things on both sides. Escalations are happening, and it's just not gonna solve the inflation problem, let alone the conflict itself. So I bring to you the approach that I use, my area of expertise, which is called modern monetary theory, MMT for short. And some of you have seen me speak about this pre the inflation cycle, and a lot of the outside observers, when they hear MMT, when they say you need to spend more to deal with inflation, that doesn't make any sense, because we usually think, well, the more we spend, the more inflation goes up. Well, my argument here is that if you spend strategically in the right spots, and if you tax and regulate strategically, you can actually reduce inflation when you're spending more. You can also spend more and cause more inflation if you're spending in the wrong places. So this is what I'm introducing very briefly here. So how much can a government spend without causing inflation, right? The mainstream approach tells us, well, tax revenues, that's what you spend. Maybe you can borrow a little bit more. I'm talking about the federal government here. But beyond that fiscal space, any additional spending will just cause a cycle of inflation, maybe even hyperinflation. My argument, the MMT argument, is that there's this additional fiscal policy space that we're not tapping into because of this illusion that it's going to cause hyperinflation. And that additional spending capacity is not infinite. Notice it's constrained by the actual risk of inflation. So as long as we can tap into that bright yellow space, strategically spending in things that actually matter for the economy, before we get to the red bar, which will start the cycle of inflation, we're good. So my argument is that why are we not tapping into that space? Number two, how can we actually identify where that red bar is, where the limit is? And number three, can we introduce strategies and policies that actually take that red bar and push it further out and give us more space to do the things that matter for us, national priorities, health, education, infrastructure, all of that stuff. So I become, therefore, obsessed with that risk of inflation. What determines the risk of inflation? And that's really the central focus of MMT, is not saying that the government can spend more. Of course, we know the government can spend more, but at what cost and what are the consequences? I'm obsessed with that red bar. What determines that, so that we know actually how much we can safely spend in a democracy on national priorities without bankrupting the country, without causing inflation, right? And once we have inflation, our analysis will tell us what's actually causing inflation, so we can target it and with actual solutions. So for me, what determines inflation, the risk of inflation is, as I said earlier, number one, the lack of productive capacity, logistics, supply chain disruptions, and all that. The good news about this risk is that we can actually reduce this risk and create millions of jobs by investing in building more productive capacity. Productive capacity is producible. It may take time, it may take training and so on, but as long as we do it strategically, it creates more jobs and it helps us build resilience in those inflation pressure points and actually pushes the risk of inflation further out. Number two, as I mentioned earlier, it's abusive market power and price setting behavior. The good news about this is that, or good news, bad news, is that we know how to deal with abusive market power. Antitrust laws, regulations, tax and regulate abusive market power. But that now brings the question of the democratic process. Do we have what it takes and the 535 people who represent us to actually do this, to go after abusive market power with antitrust regulations that make sense in 2022 rather than 100 years ago, right? To actually go after the abusive market power and democratize the economy, truly, right? So that second point is more of a political thing, but that's what inflation is. So if we figure out as a society how to do one and two, essentially what we're doing is we're going into that bright yellow space and we're pushing that risk of inflation further and further out, which means it gives us more spending capacity beyond what we usually call tax revenues or borrowing. That is deficit spending at the national level. So that's in short what this paradigm shift is about. Whereas most people are thinking we need to reduce spending to fight inflation. Now tell me this, how is reducing spending going to end the conflict in the Ukraine? Stop the supply chain disruptions on a global scale? How is reducing spending going to deal with big pharma's abusive market power? How is it going to deal with the shortage of affordable housing or education and all of that? It's got nothing to do with it. It has nothing to do with the actual sources of inflation. It doesn't mean that any increase in spending will fix it. No, the increase in spending has to be targeted in those areas so we can actually get the results of increasing capacity and so on. So can we kill green jobs? Sorry.
Don't if you reduce demand down to productive capacity?
You can, yeah, and I'm gonna get to that.
That's a depression, but it's,
So you cause unemployment.
yeah,
Right.
because unemployment, that's the only way to get there.
I'm arguing it's not the only
Well,
way.
I'm saying that's.
Yeah, from a mainstream perspective, it's the only way.
Of getting
So can we kill inflation with green jobs? Yes, we can. Remember that phrase?
there.
So over the last couple of years, I've been involved in this green jobs report analysis with a couple of my colleagues from a company called HIP Investor. HIP stands for Human Impact and Profits. HIPinvestor.com, I think is the website. You will see it here. But also there's HIP Investor, the book that talks about this approach. So what HIP Investor does with my colleague Paul Herman and his team, what they do is they look at what we call the triple bottom line approach to business. So normally we rate corporations based on their financial performance, their profitability. The HIP method looks into not just the financial bottom line, but the impact on people, the impact on the planet. So kind of more of an ESG approach, more of a sustainability approach, people, planet, profits type of approach. So, and these are some of the basic pillars that they use in their database to track how to rate companies based on their performance, not just financially, but in terms of the impact in terms of health, wealth, earth, equality, trust, the products and services, meaning their supply chains, and management practices. So these are the 7 pillars that they input, and they rate over 2,000 companies in the US and an increasing number all over the world. So what we end up with is basically a 0 to 100 rating of these companies, like scoring them. 0 is dystopia, right? It's a disaster, right? 100 is utopia. It's like the ideal company that's financially successful, has the best impact on people, the best impact on the planet. And we try to figure out how green those companies are versus how extractive. So extractive are those red coded things. Green are the greener companies. So what we did with this project, we took the HIP rating of all of these corporations, and we tried to map it out against the jobs that are being created on a monthly basis. So we're trying to see how green our economy is based on this rating, how green are the jobs. And we see the difference between green jobs versus extractive jobs. We want more of the green jobs, and I'll tell you why. So very briefly, green industry jobs recovered faster after the COVID pandemic. Notice when the pandemic hit, all jobs were lost across the board. Green industries, extractive industries, semi-extractive industries, but the green industries lost the fewest jobs. They were more resilient to the pandemic. And during the recovery, after we reopened the economy, green jobs recovered at a faster pace than the rest of the economy. And it took a long time for the extractive jobs to catch up with the level of recovery. But unfortunately, we're going now into a phase where the extractive industry jobs are coming back with a vengeance because we haven't made the strategic decisions to double down on that recovery of greener jobs and really transform our economy into a more resilient economy and so on. So green jobs are more resilient. Green jobs pay better across the board than the extractive jobs and slightly extractive jobs. And historically, green jobs have the highest wage growth. So this is the future we want, right? So green jobs happen to be, the majority of them are jobs that actually help us deal with those inflation pressure points. They're jobs that pay better, they're resilient, they're almost like recession-proof industries. Why haven't we doubled down on what the data is telling us and actually massively invest in transforming the US economy in that direction? Green industry jobs, as I said, are the most resilient to job losses. This is the unemployment rate by industry greenness, right? So the green jobs have the lowest unemployment rate compared to extractive industries, not just during the COVID pandemic, but in general. So it's a no-brainer. This is the source of growth. This is the source of wealth. This is the source of resilience. And it happens to be the kinds of jobs that actually help us deal with inflation pressure.
What's the size of those sectors of the economy?
The majority of the US economy is in the extractive side. Yeah, the majority of the US economy is on the extractive side.
Yeah.
Right, which is the opportunity here is to commit to the other side.
Can you define extractive more deeply?
Extractive is based on this rating that we produced here, based on these 7 pillars: health, wealth, earth, equality, trust.
So oil
Products
and
and
gas
service.
extraction and
Not necessarily just oil and gas. Oil and gas is obviously extractive, but you can have
metals.
things like the casino industry is extractive, right? Because it's 7 pillars give it a lower rating.
The reason I asked the question, I
Yeah.
think in extractive, it seems to me you'd have oil and gas, you have other things like metals and other raw materials.
I understand, but that's not the term that we use. We use based on, we labeled green versus extractive based on these 7 pillars that combine the profitability and the impact on people, the impact on the planet.
Okay, well, my point is,
Mhm.
from this perspective that I see on extractive, if you don't have extractive, you aren't gonna have green,
Agreed?
because it's input to some of the other
Sure.
sections, so. I don't know that you can separate them necessarily, is what my comment.
What you call extractive for raw materials, let's call it mining, what it is, right?
Yeah, it could be
That's
gold,
not-
it could be metals, it could be
Sure.
anything.
But that's not what the label extractive is. It's
Understood.
a much broader category.
I understand.
But we agree, mining creates the input for the green economy and so
Yeah.
on. But there are mining practices that are way
Terrible.
more harmful
Yeah.
to people, to planet, wages,
Yeah,
trust.
no question on
Yeah,
that part. I'm
absolutely.
just saying, I'm thinking the definitions may be a little narrow.
That's why definitions are important, so that we know what we're talking about. So can the Fed fight inflation? Because this is what the Fed has been doing. This is kind of what we're doing. They're doing inflation targeting. Can you hit the target? It's a moving target. You can't control it, right? If the root causes of inflation are far beyond the reach of monetary policy, if it's something in the Ukraine, if it's something in China, how can the Fed fix it with higher interest rates? Fiscal policy is better equipped to target inflation pressure points because you directly invest in the productive capacity you need, in the logistics you need, and the supply chains you need. You directly go after abusive market power with the fiscal authority that you have in a democratic society. The Federal Reserve Bank has very little impact on inflation. As a matter of fact, raising interest rates may actually make things worse, as raising interest rates raises the cost of doing business on everybody, right? Raises the cost of debt. So it will certainly slow down the economy in terms of demand, cause unemployment, because unemployed people can't buy a new dishwasher, right? So that reduces the demand. And what a gratuitous way of causing pain to millions of people, damaging the economy, when we could actually be building more resilience with the other tools that we have in a democratic society. That is the missed opportunity. So essentially what the argument here is from an MMT perspective is that these are the really kind of the nature of prices, of inflation is always inherently legal, regulatory, administrative, budgetary, more than related to what monetary policy does. And these are all the keywords that people don't want to use in public policy, right? But these are the tools that we've given up on and kind of handed the keys to the Federal Reserve Bank and to the private sector to do what they think is reasonable. And I think we've gone too far in that unreasonable territory. I think we agree on that. So to conclude, yes, we can kill inflation with more, not less strategic investment in green jobs. The climate crisis, inequality, poverty, exclusion, injustice, all of these urgent problems call for bold transformative actions, not more of the same and small incremental solution. The current climate and jobs policies that we use in the US and beyond are too weak, too slow, too expensive, ineffective, and actually dangerous in the long term in terms of the inflation side, in terms of the impact on people, on the planet. So I argue, and I've been arguing, that economic justice and climate justice via living wage, Green New Deal type of investments in green jobs are possible, desirable, and affordable. Thank you.
Thank you.
Wow.
I'm happy to answer questions.
I have a question.
Go ahead.
Oh, I just wanted to know, is this a matter of redeploying economic resources in the United States or creating new economic resources?
Both.
Okay.
Yeah. Better management of resources is always a good thing. And this is the thing that a lot of people sometimes forget, because we have this kind of built-in assumption that any new government investment, say in public housing, for example, affordable housing, is going to be inflationary. But we never think that a company getting a bank loan to build a casino in the same town is actually inflationary, because they're literally competing for the labor, for the cement and concrete and construction materials that we're using for public housing. That's what drives up the demand and creates shortage. We only think of the public housing investment as inflationary and bad for the economy. But the casino that we're building is it's taking those resources and competing for shortage of labor, shortage of materials. We never talk about that side. So it's a question for us as a society, when we're dealing with national priority problems that involve actual shortage and competition over resources like construction materials and skilled labor. We only shut down one side, but we think of the other side as just fine, like not to be touched.
Yeah.
We have to, at some point, especially in times of crises, actually prioritize what is important for dealing with inflation, not just one side of it. So rearranging how we use resources, prioritize resources, and investing in productive capacity. Because when we have a shortage of skilled labor, the only way to do it is to actually produce the skilled labor. How do you produce the skilled labor? With vocational training and education and investments in efficiency, and all of those things don't happen magically, right? And markets, meaning for-profit institutions, don't really have the responsibility for national public policy. They have a responsibility to do what's best for them. So they can overlook all the needs of the rest of the economy, and you can't blame them. Who do we blame? We blame our public officials in a democratic society who are supposed to watch for the long term, the overall kind of the whole picture, and figure out where to incentivize investments and priorities on a national scale. So we need to do a lot more on that front. And to be honest, we've been doing a little bit. I joked, I said we didn't have a Green New Deal. Yes, because it was politically not acceptable in the US. So we went to a smaller version of it. It was called the Build Back Better. And that was not even acceptable because it was too much and all that. So then we went to even a smaller version of it. It's called the Inflation Reduction Act. When you think about it, the Inflation Reduction Act is actually a genius idea, because prior to this whole MMT kind of theoretical perspective that we've been pushing for the last few years, when there's inflation, everybody says the Fed does it, not Congress. But can you believe we have an act of Congress called an Inflation Reduction Act, which is an acknowledgement that Congress can actually fight inflation, which is what I'm arguing here. Except we didn't do the whole thing, a Green New Deal. We kind of a tiny small portion of it, tax and regulate a little bit of abuse of power, market power, just 20 prescription drugs, not the whole thing. Go after, high income corporations that have massive, tax them a little bit more, kind of the tax and regulate abuse of market power, a little bit, not too much disruption, and then invest in strategic productive capacity to decarbonize the economy, all the green technology that is giving huge incentives to relocate to the US, to create jobs in the US. That's what we're talking about. Let's take the Inflation Reduction Act and make it bigger, something like Build Back Better, or even bigger, like a Green New Deal. ultimately, that's where we should be going. And I think there is a recognition that the economics of the Inflation Reduction Act is exactly what we need. But unfortunately, the politics of the nation is not there yet to scale it up.
Gets in the way.
Yes, please.
Have we learned anything from history like our grandparents dealt with Roosevelt?
Yeah.
Have we learned a lot from that?
Absolutely. That's why we picked up the same label, like Green New Deal, as in the actual New Deal. I mean, there are things that we should have learned from history, right? When the US went from the Great Depression, the misery of the Great Depression, to fighting World War II and winning World War II, how did we pay for World War II? Where did the money come from? There was no wealth to be taxed or borrowed during the Great Depression. And we go to fight the biggest war in the history of the world and win it with massive spending. So the government at the time understood that the problem wasn't finding the money to pay for the war. The problem was finding the actual resources, physical resources, productive capacity to fight the war, and finding the regulatory power and finding the sort of patriotic understanding in the corporate sector that you should not take advantage of the war to raise prices, because there was actually shortage of productive capacity. We took over the city of Detroit, basically, and we turned it into manufacturing for military purposes. There were no new cars produced during those 3 years. So the workers that actually built the war material, right, created the physical resources to win the war. We paid them decent wages. In a free society, what do people do with their wages? They're free to buy a new car, buy a new house, enjoy the recovery from the Great Depression, right? But they couldn't because there were no new houses being built during the war. There were no new cars being produced. So if we haven't identified how we actually manage the risk of inflation during that war, we would have lost the war. We would be speaking German today. We've gone through hyperinflation. All kinds of disasters would have happened. But here's how we did it. We paid them decent wages, and then we told them, we leveraged kind of the patriotic mood of the nation, buy these freedom bonds. Please don't buy a new car. Please don't buy a new house. Wait until after the war when we actually have people to build those houses and cars. For now, take your income and buy a government bond. In other words, save your money. We promise to pay you back in 10 years when the war is over, when we actually have. And that's how we manage to keep spending down, not by taxing people into poverty, not by causing unemployment, which is what we're about to do now. We're actually getting them to work, recovering from the Great Depression, but then managing to convince them to postpone their consumption until after the war. And then after the war, we switched gears completely. During the war, we switched the city of Detroit to produce engines and tanks and things for the war. After the war, we switched the other way because now we can spend on consumer goods because we have the workers, but all the workers, that pent up demand for housing and cars and the post-war kind of recovery, we had to get a company like Boeing, right, which produces airplanes and engines and military equipment. During that post-war period, they had to step in and help. They actually produced furniture for homes because there was a lot of demand for furniture and houses and all that. So we knew how to manage the risk of inflation. If Boeing didn't do that, we'd have had inflation because there's too much demand for furniture and housing and all that, and we don't have productive capacity. So we invested in productive capacity. During the war period, we switched productive capacity to the things that we actually need. Otherwise, we would have had inflation. So we know how to do this. We just forgot those history lessons from back. We knew how to kind of tame that market power during the war with actual policies to control prices. We had a thing called price control administration, right? We don't have to go to those extreme measures today, but we have to figure out the tools that allow us to get things done and keep prices under control and keep this democracy alive, not just in terms of elections and November votes and all that. Democracy is also democratizing the economy. So that's the lost tradition that we need to reintroduce and relearn as a nation.
The CHIPS Act, or the CHIPS part of the inflation
Sure.
bill brought Intel to Ohio. And I got really disappointed in the hypocrisy of the state government, who immediately subsidized highways, tax breaks and all the rest in the billions.
Yeah.
Without telling us what it was, but they could never do a housing project
Sure.
or anything for poverty. But now I'm thinking it was probably the best thing they could have done. To encourage Intel to come.
It could have been done better.
And-
We're not saying bringing Intel jobs here is a 100% bad thing. It's a good thing. And it
Yeah.
built that resilience to supply chain, creates good paying jobs and everything. But it's the terms of the deal that could have been more democratic, could have been more inclusive. And guaranteeing employment to people in the state, in the region. All of those things, we just don't know what the terms are. We're just told these vague things that we're gonna invest in training and education. We're gonna create these jobs, but we don't know what the deals were. And the subsidies from the state are substantial,
Yeah, billions.
beyond anything that's
Immediate.
ever
They
been.
didn't
Yeah.
worry about tax collection
Right.
or
And
budget.
And they would have come to the US no matter what,
Yeah.
right? It's just a matter of
Where?
which state will get them.
Offer
And
the
we're
best.
into this philosophy of let's race to the bottom. Let's Ohio's competing with Indiana. Indiana's competing with Atlanta. Atlanta is competing. That race to the bottom.
Yeah.
We, the people, don't win from it, obviously. And it's all to the advantage of
So how do you avoid that with taking on this extra spending to get?
that extra spending I'm talking about is federal government, not state. Because the federal government can go into deficit because it has the sovereignty of the currency. The state of Ohio is like you and I. You and I have to earn an income to spend. We can borrow up to a certain limit, but that's it. You know, the bank will cut you off eventually. The state of Ohio is the same thing. We tax the people of Ohio to spend. We borrow up to a certain limit. And then whatever we borrow, we have to pay it back eventually with taxes.
Yeah.
The federal government has that additional spending capacity
Printing
that
capacity.
none of us
It is
have.
money.
So it's the responsibility of the federal government to tap into that space and
Okay.
use the long-term strategic investments that create the environment within which the state of Ohio doesn't have to do that.
Yeah.
Right? If the state of Ohio is resilient and has all the investments and infrastructure and support from the federal government, then it doesn't have to race to the bottom with all of these subsidies to bring it's again, state by state, we're divided.
Yeah.
So we have to have a coherent narrative as a nation to understand that this aspect of abusive market power is just not productive, right? And it's not helpful in the long term for the country. Yes, please.
What about all these trillions of dollars they say we owe? Who we owe?
Very good question.
Yeah, who do we
Yeah.
owe?
So the national debt, right? So let's, yeah, exactly. So let's start with what is the national debt? The national debt is the summation of all the previous deficits that the federal government has accumulated. You know, every year we have a budget, government spending and taxes. We usually spend more than what we tax. We have an annual deficit.
Yeah.
So you take the annual deficits and add them up, minus the few years we had surpluses, literally few years. That full amount from the beginning of the republic is called the national debt. So who do we owe it to? In other words, who's holding those government bonds where the federal government is promising to pay back? I don't have the numbers in my head, but roughly 50% of that national debt is owned by the Federal Reserve Bank, which is the US government, right? So it's like I have money in the right-hand pocket or the left-hand pocket, it doesn't really matter where it is. And that debt that the Federal Reserve Bank has is the most important tool for the Fed to stabilize the economy, to stabilize inflation, to stabilize interest rates. When you look at what the Fed does on a day-to-day basis, they're constantly buying and selling bonds, not to make money, they're not speculating. when they buy bonds from the market, they take pieces of paper called government bonds and they put more liquidity in the system when the system needs it. And then the next day or the next week, if they need to reverse that, when the Fed sells bonds to anybody in the market, it's taking reserves or cash away from you, from the system. So that's how the Fed manages the volume of liquidity needed. So it's a useful policy tool. And Alan Greenspan, when he was asked about the national debt, should we pay off the national debt? His answer was actually pretty on point. He said, if you pay off the national debt and take away this tool from us, the Fed, you might as well shut down the Fed because we can't really function and manage the economy. We need the national debt to do that. So that's 50% of the debt. The other 50%, the majority of it is owned by pension funds and hedge funds and financial institutions who use it as part of their whole portfolio of assets to diversify their assets. Their assets go from risk-free to very risky investments, everything in between. Risk-free is government bonds because the federal government doesn't default, never default, right? So that's the AAA rated asset that keeps your portfolio stable. So it's very important for financial institutions to have a risk-free asset that anchors their financial position. So lots of it is in the US, but also financial institutions around the world. They use the US government bonds as the risk-free asset in their portfolio too. Central banks around the world use it also as their anchor for the financial system. We're the biggest economy in the world. We're the most stable economy in the world. So it makes sense that we dominate in terms of dollar transactions around the world. Countries that have massive exports, they earn dollars, right? In cash. Well, what's the safest way to save those dollars? Not under the mattress, but to buy US government bonds. The Chinese central bank does it, the Japanese central bank does it, the European central bank, all major central banks use their reserves to buy US government bonds to keep that anchor for their economy. It's actually a huge privilege that we have, that the rest of the world wants to buy our debt with almost zero interest for a long time, because it's important to their stability, not because we need their money. So it plays a huge role. There's a huge difference, and that's why the word debt is misleading, because when I have debt, I have a problem. When you and I have debt, that's not the same thing as the federal government. When I have debt, I have to work hard to earn that income to pay my bills, pay off my debt. I have to reduce my spending, tighten my belt financially to get out of that debt burden. The state of Ohio, the state of New York, same thing. Their debt is a burden because it means tax more to pay your bills, spend less so you can get out of that debt. But the federal government, especially the US federal government, which sits at the top of the hierarchy of international currencies, so to speak, plays a completely different role, right?
So we don't owe China, right?
Technically
You hear a lot
speaking,
of people say we owe
Absolutely.
China.
misleading. Here's why.
Okay.
If we go back to the 1980s, that same phrase would have been, we owe Japan, because Japan was the rising power at the time, economic. Well, Japan at the time was the second largest economy in the world. It was the biggest exporter, right? When you export, you earn dollars. What do you do with your dollars? Under the mattress or in government bonds? Of course, in government bonds, US government bonds. So it makes sense for the second largest economy in the world, Japan at the time, to have most of its wealth invested in the safest thing in the world, which is US bonds. But we think of it as we owe them money. No, they actually need it. And they need those government bonds for their own stability. So today, what's the second largest economy in the world? The biggest export is China. So it makes perfect sense that they own $1 trillion worth of US government bonds. And if they decided, some people say, oh, they're going to hurt the US economy. At some point, they're going to dump all of those bonds and cause a market crash. Now, why would China shoot itself in the foot? Take $1 trillion of its wealth and cause a currency crisis in the US and destroy their wealth. And then go to what? What's the second best thing? The euro, the unstable currencies, weak economies? No, you stay with the most stable financial asset, the safe. That's the privilege that we have. It's unfortunate that a lot of people see it as our weakness when it's actually a symbol of our economic strength. that everybody else wants to take their wealth and give it to us and hold on to a piece of paper that promises to pay them back with a little bit of interest.
China's been trying to establish their yuan as the.
They'd love to be in our position.
Yeah, they want to do that. They've been trying to do that in several different places. Not too successful from what I've heard,
Well, they're coming from far behind. China is a developing country,
still, in a lot of ways.
but of course, but if we keep thinking in this way, that we can't afford to invest in the things that actually strengthen our economy, our industries, our jobs, our education, technical training, the things that made the US economy strong is innovation, the technology and education. Not divestment from those things, investments in those things. So if we live with the mythology that we can't afford it because we're broke, then that's gonna be the result. It's gonna be the countries that actually invest in those things that will catch up and lead and will fall behind. And a lot of it is actually signaling that if we don't wake up to that reality, we're gonna fall behind.
My next question is, think about this. Why are you putting money in the bank for? Why don't you put it in government bonds? Why don't you put your money there?
Well,
To help the government, instead of helping the banks ain't paying out of it.
well, from an individual, from a consumer perspective, the government doesn't actually need my money. The government can, when it decides to spend strategically, like winning World War II, right? Or paying for the COVID relief during the crisis, or, dealing with any major crisis, the government doesn't wait for us to buy those bonds or pay those taxes. The government can just do it like we were during World War II. We didn't wait for people to be taxed. There was no money to be taxed or money to be borrowed. The borrowing of money, quote unquote, borrowing, what happened during the war, after we created the jobs and gave people the income. So the reason why individuals invest in stocks or bonds in the corporate side is because it gives you that higher rate of return, but it also comes with a risk. Because not all, notice what happened with all the, Enrons and the Bitcoins and all of that. It comes always with the risk. What we're talking about is the investments that the government needs to do so that we have what it takes as a nation to produce the wealth and the economic stability. And then we as individuals, we can decide where to invest our money.
So we should not be so alarmed about the national debt getting higher every day.
No, we should be alarmed by the lack of investments, by the policies that the Federal Reserve Bank is telling us explicitly. They're saying, here's how we're gonna fight inflation. We're gonna raise interest rates, and we're gonna go as far as necessary, even if we cause a recession. This is not me speaking, I'm paraphrasing Jerome Powell. That if we cause a recession, that's too bad, but we're gonna do it, right? Not even thinking of the millions of people that will be in that recession and what it means for them and for their future, and not even telling us the truth about all the actual sources of inflation that are way beyond his jurisdiction. He can't do anything about them. He can at least point us to the 535 people who have the tools to do it and say, I'm sorry, guys, I can't really fix this inflation for you. You're gonna have to do it. You're gonna have to invest in productive capacity. You're gonna have to tax and regulate abusive market power. You're gonna have to deal with the supply chain disruptions. You're gonna have to figure out a peaceful solution to this mess in Europe. Those are the actual things that will end the inflation pressure points. That's what I would expect from a leader of the Federal Reserve Bank, is to acknowledge what you can do and what you can't. They don't tell us what they can't do. They just tell us we have one tool, it's a hammer, and every problem looks like a nail, so we're gonna hit it until somehow that inflation goes away, right?
They tried a lot of things all through the years. You'd think they'd know by now. Well, what they say, if I was president of the United States, I don't care what anybody says. First, I'd go after the rich people who ain't paying their taxes. And that's not right. And that's why we're so far in debt, because the people are not paying their share of taxes. We're paying more taxes than they are. You think that's fair? No, it ain't
Absolutely.
fair. And here's
Absolutely.
another thing. If you're the president of the United States and he sat down, don't care who you are, the first thing of it is, we're in debt, clear up over our eyeballs. And the second thing is, you only got so much money to work with. Social Security, people, they can't do away with that. A lot of people couldn't make it if they do it. And Medicare is driving it clear through the roof. So you got two issues, takes billions of dollars just to run that. I don't even know how they even run the thing.
A question in the back, sorry, you've been raising your hand for a while.
Yeah, I'm curious if if you used disruption a couple of times in your presentation. And
Yes.
has this crypto industry, whatever you want to call it, has that added to this disruption in any way, or is it?
It added to the confusion, you know, when the real economy, when the real policymakers let us down and let people down, people are desperate to find their own way to survive, to make a living, to build some wealth. And crypto came and said, all of that mainstream economy, the government, the Fed, something fundamentally wrong with it because the way they manage money. We're gonna create this decentralized money that's not controlled by government, not controlled by, and its value goes up and up and up. And started with Bitcoin and all the other stuff, and created also another confusion between the encryption technology versus the thing that they call currency, cryptocurrency. Cryptocurrency is not currency. The encryption technology is great. It has lots of applications and future and efficiency, all of that. Got nothing against encryption, but the thing that they call it's a speculative asset. Yeah, built out of nothing. Yeah. And of course, when you engage in speculation, all you have to do is buy low and sell high. You can make tons of money. If you can somehow be lucky or figure out when to buy and when to sell, but the whole system as a whole is a fraud.
Right.
Yeah.
Could you say that, could you characterize it as, you were talking about extractive industries, and that's kind of over extractive, right?
Absolutely, yeah. Well, we don't have it rated here, but.
No, but I'm
not-
talking about the quantity of it, there's, it's billions, every day, there's another, $10 billion lost to fraud or what, direct fraud or whatever. But is that having any, is it reached the point where it's having any other effect? No.
Other than, creating wealth for some lucky people and ruining other people's lives.
Okay.
Yeah.
It's kind of off the subject, but it's been concerning me a lot lately, maybe because of this idiot in Texas. Can you talk some about Social Security?
Yeah. So, and when I talk about Social Security, I'll talk about it from an MMT perspective, right? That additional fiscal policy space that we have and all that. There's the way the Social Security Administration was created during the Great Depression in the 30s. It was designed by FDR in particular to keep it permanently alive, was unfortunately politically very smart, and it did make it, survive the political cycles and the economic cycles. But economically, it was misleading. Financially, it was misleading. Because we have this pay-as-you-go system called pay-go system, where the working people today pay their FICA taxes and contribute to the Social Security Trust Fund. The Social Security Trust Fund is invested only in government bonds, safe assets, right? Not speculative, risky assets. And today's retirees are paid from that trust fund. On day one, when we created the Social Security Trust Fund, there was already retirees. Those retirees never contributed to the fund, they're just retired, and we needed to provide them with resources to survive. So we created that pay-go system where we said, okay, today's young people, you work, you pay taxes, and we feed the elderly people of today. With the promise that when you retire, the young people of that future generation will be the ones contributing to the Social Security Trust Fund. So it's kind of that model, pay-as-you-go system. And that created a political commitment to it that's regardless of Republican, Democrat, it doesn't matter who you are. Everybody who's retired says, I don't care, I contributed to this thing, I want it to pay me back, right? Of course, I wanted to pay me better, I want the better retirement conditions and all of that. So from an MMT perspective, the retired people who receive money from the trust fund, right, from their Social Security, what do they do with their Social Security checks? they actually use them to buy things, right? To pay for transportation, health services, fixing the roof, whatever it is, real resources. So in order for the retirees to have a higher standard of living, it's not just the money that we pay them. The government can always pay them more. We have that additional fiscal space, right? It's what they do with the money. So we need to have the workers, the productive capacity to provide the services for the retirees who are not contributing to the economy now because they've already contributed in the past in terms of their productive capacity. So when we look forward to 10, 20, 30 years, when they tell us the Social Security Trust Fund is gonna be empty, right? So when the Social Security Trust Fund doesn't have enough cash to pay the future retirees, the baby boomers and beyond, they're telling us there's gonna be only a few ways to do this. We either make retirees work longer so that they contribute more to the fund, or we tax more so that we have more cash into that fund, or we reduce the benefits to retirees, make them less, right? Now, the demographic shift that we're having is that we tend to have healthier people who live longer, which is something to be celebrated, not to call a problem. That is actually what we want, people to live longer, healthier, and enjoy their retirement. We also have fewer people, young people working, right? And that's also something to be celebrated because we've invested in productivity. So with fewer people, we can do more, right? And that's how we've always done this. This is not a new problem. We've gone from lots of people contributing to support one retirees to fewer and fewer and fewer. Now I think we're less than 3 per retiree. And we can go, and all of that is productivity.
Come on, it won't work for productivity per se. I've seen statistics on that, how much we've improved over the years. We're the leader in the world, I understand,
Right.
productivity per person.
And that only happens with investment,
That's right.
not with divestment.
That's
Which
correct.
brings us back to that question. So the challenge for us is to think about how do we face that demographic mismatch moving forward with more retirees living longer, healthier lives and fewer workers. The only way to do it is to continue investing today in that productive capacity so that we have the economy and the economic wherewithal to actually provide them with the services they deserve. So the real challenge is not finding the money to send them the checks, it's finding the productive capacity to deliver the things that the retirees need.
Why
And
is
that only happens with more strategic investment in the main areas that retirees need, which is health and pharmaceuticals and the care economy, caring for people, caring for the other. That doesn't happen overnight. To produce, quote unquote, to produce a skilled doctor, it takes years.
Yeah.
Right? We're not going to snap our fingers in 20 years and say, oh, we have shortage of doctors. Well, you're going to have to start producing those skills today by investing in education and research and development. And to make the cost of health services affordable in 20 years, you're going to have to make sure that those doctors don't come out with $300,000 worth of debt that they have to pay off with higher cost of delivering healthcare.
and decorporatizing healthcare?
Thank you.
Okay, why is Social Security such an attack? Why do they all seem to think that doing away with Social Security is going to cure the economy?
I think it's related to the point we were talking about earlier, because Social Security, when it goes into deficit, it's a quote unquote burden on the federal government. And it adds to the national deficit and the national debt. And if we think like a household, I have a debt burden, how do I get rid of it? Is I reduce spending, right? So that's the problem. The federal government is not a household. The federal government is not like you and I. It's not like the state of Ohio. It has that additional spending capacity, it has that long-term strategy to invest in the things that matter, to tax and regulate the abuse of market power. I mean, one of the reasons why the cost of healthcare is so high, the cost of retirement services is so high, is because we've let a few corporations control the industry, healthcare industry. We let the American Medical Association decide for the nation how many medical students get to actually become doctors. So when you create artificial shortage of doctors, you make sure that the cost is high. So when you have a club of privileged individuals who want to keep their market power and market control, they reduce the amount of doctors that we train. They make sure that they're strapped in debt for the rest of their life, so that when they join the club, they join the philosophy of the club that says, we need those wages to be way up here, so we can pay the debt, have the house, have the, and all of that. Instead of the noble profession that it was meant to be, right? That is a problem. If the government doesn't step in and say, we as a democratic society, we can't let a small group of privileged people decide on the health and well-being of the nation based on money-making motivations, then we're not in a democracy. Right? A government of the people, by the people, for the people, not a government for the super PACs, the privileged clubs. Right? So we're gonna have to face that link between democratic principles that we all believe in and the link to market power, inequality, and inflation.
Since you brought up this whole question of the medical side, how do you compare what we do in terms of the medical industry versus nationalized medical systems in Canada? What's better and why would you want one or the other?
I mean, so the system that we have that relies on private health insurance creates that market concentration and creates that, and it's a whole interlocked system of market power that creates shortage of productive capacity. It creates incentives, built-in incentives for much higher cost. It creates a lot of middlemen who need to be paid to do all the paperwork for your reimbursement for all of that. It's a question of allocation of resources. Do we want to have more staff doing paperwork, figuring out what to deny and what to approve and how to transfer the payments and all that? We have a small army of those people, close to 2 million people working in just paperwork related to health insurance. That's a lot of people. That's a lot of jobs, right?
A lot of
But
crooks
as-
too.
I'm
A
sorry.
lot of crooks in here.
There's plenty of that, but here's where it really pains me. And I was at a conference a couple of years ago before COVID. We're sitting at lunch talking to people I didn't know, and one of them was a doctor, a surgeon. So I told him, so where do you work? What do you do? He said, I work for an insurance company. And then he kind of put his head down a little bit, almost in shame. And he said, well, I'm curious, what do you do with an insurance company? He said, my job is to get all the paperwork from, the billing, the surgery costs, and go through it item by item in detail and make sure that the hospital and the surgeons actually did their best to reduce the cost, that they didn't overcharge us, the insurance company, and make sure that this was medically necessary. And at the end of the day, the more of those things you deny, and as a result, you bill the patient, the more profitable the insurance company is. That's just not right. That surgeon was trained to provide surgery, not to deny people coverage and to drive them into medical debt that bankrupts millions of people every year in this country. That's just very bad misallocation of resources in productive capacity. We want that surgeon serving, and I think all people who go into that medical profession, they're driven by, yes, you make a decent income and all that, but they're driven by the passion they have for the noble profession, for helping people. The vast majority, maybe there's few who are not. And somehow we create a system that drives them into massive amount of debt as students. They go in and practice. They manage to pay their medical school bills 15 years into their profession. And then they have kids going to college, they have other things. So the job that the health insurance company offers is the way to pay for your kids' education. So they don't spend 15, 20 years of their lives paying student debt. I don't blame the individual. And I truly felt in that just brief conversation, when he put his head down and he said, I work for an insurance company, it was that guilt that a lot of people in the profession don't want that guilt. And yet we create this very perverse system, right, that doesn't serve the majority of us.
I won't keep you any longer, but how do you think we can reduce the market power of in industry when any company in that industry wants the powerful guy to raise prices because it provides him an umbrella to raise his price. It's only the consumer who doesn't want market power. But
consumer is also a citizen.
It doesn't have the financial power to lobby for it.
That's why we have a democratic system. A consumer is a citizen, and a well-informed citizenry is what we need in a democracy. Right?
Well-informed.
Well-informed citizenry
Right.
that identifies where the problem is, because if the public is convinced that inflation happened because of, who knows what, the Fed pumping too much money, whatever, then we're gonna get these solutions. And I guess, yeah, if the Fed pumped too much money, then they should raise interest rates, and we're gonna have to go through this pain, and I guess there is no alternative. But if we have a well-informed citizenry that calls their bluff and says, well, we know what's causing inflation, and we know why you're abusing your market power, and we know that we live in a democracy, and we have 535 people that we could unseat if we wanted to, because they're supposed to be of the people, by the people, for the people, then we have a real democracy. Then we can dismantle this abusive market power. But if we accept it, I don't expect the 535 people to disrupt the political system that they operate in, with all the good intentions that some of them have, because it's just too deep, right? So that's really the challenge. This is why events like this, where it's actually learning for the purpose of not just, let's hang out and talk about something interesting. This is what democracy is about. We should be having these conversations in every public library and every platform, because we're all in this together. And it's the more informed we are, the easier it is to call their bluff when they say you have no choice.
Yay.
Yeah. Thank you.
Thanks, Fadhel.